Welcome to the Daily Update, where I'll go over the action in the market for Monday, June 5th, and then we'll see how things look for Tuesday, June 6th. Happy D-Day. It's a very important day in American history. We always want to make sure we reflect on the bravery and the sacrifice that a lot of people made on this day back in 1944. Looking at the market, we had a bit of a down day. We're having some trouble now getting through 4,300. We had a lot of trouble getting through 4,200. We finally did that. Now the market is challenging the 4,300 level. We're still short-term overbought or extreme positive right now, a little bit in the intermediate term. The market is still looking more positive overall. Some of these negatives that we've been following are starting to show some improvement, even with the down day. Before I get started, I did post another supplemental video Monday, June 5th. It has to deal with hedging. I also call it protection. It's a way of being able to insure a stock that you buy or maybe your overall portfolio. I feel that's a very important video. I teach this in my other classes. I hit this at a pretty high level where I go a lot more in depth in the courses that I teach, but still, I think this might benefit some of you. I do have a PDF of the slides and charts. You can download that and follow along if you're having trouble seeing the charts on the screen. I do have a private Facebook group that you're welcome to join. I do have a new poll that has been posted, and a few of you have already taken part in that. And just in case you can't find videos on YouTube, I also have a Rumble channel. Here is the link to that. Let's go back and talk about what happened. Right at the open, we had a pretty much flat open. Futures were not all that unchanged during the night. Prices chopped right after the open, and we found support at the unchanged level. As the day went on, prices climbed, and we got almost to R1. Not quite, because it was at 43.02. We stopped just a little bit under 4,300. Later in the day, then we saw some selling coming in, took us down below the unchanged level, but we ended up finding support at the daily pivot at 42.71, and we closed just a little bit above the daily pivot. We were down 0.2%, and volume switched back down to being below average. So our technicals, as I stated, are still mainly positive overall. You've got a lot of people that just don't believe this market should be going up right now, but our charts are suggesting that there is some improvement. Our trends are currently positive. We're above resistance, and now we're on the other side of that. So things are looking a lot better, but we always have to be prepared for things to shift and go in the other direction. The debt ceiling debate is pretty much off the table now. That's been dealt with. So now we're switching back to inflation and interest rates. We have a Fed meeting coming up next week, and so that's what everybody is starting to fixate on. What are some comments that we can make? 4,300 is providing overhead resistance. The small caps, they were up 3.6% on Friday. They fell 2% on Monday. Kind of interesting. Bank stocks were weak. There was an article, and I actually read this article over the weekend, that said that large banks could face a 20% increase in their capital requirements. Banks didn't like that very much. Saudi Arabia has come out and said that they're going to cut oil production more than they already have. It's going to be down about 1 million barrels per day, and this will start in July. That helped the price of oil go up. On a short-term basis, these are the same things that were on our list. I added one more at the end that I missed for Monday's video. So on a short-term basis, we have the Stochc RSI, the Williams Percent R, the CCI 14 and 20, the shorter-term stochastics, and then the new addition is the short-term boom indicator. We're getting pretty extreme above that 20-period moving average. Intermediate term, we're still just a little bit into the third standard deviation. The percent B indicator hasn't worked off yet, and the Sean trend meter is still extreme positive. The dollar was down just barely, and interest rates on the 10-year were unchanged. We still have all of the yield curves that remain inverted. We're keeping an eye on this because when they go back to being no longer inverted, that's when we start the countdown to see if we're going to head into a recession. Sentiment is still positive at 73, where it had been at 65. Our trend, we're seeing a trend now, folks. We haven't said this in quite a while. It's positive and strengthening, even though the green line came down just a little bit. The ADX is above its moving average, and I have it underlined here. We're back above 20, so this would be a positive trend. Now, you know my philosophy on this. If you're looking at going into a long position, I only get into a long position if we have an up day after a signal's been generated. If we have a down day, nope, that does not get generated. Our bias is mixed to positive. We're still more positive overall, but with the slight down day, I switched it to mixed. And I'm also keeping our momentum, which is 2, 3, 4, 5 days, mixed to positive as well. Until we can get above that 4,300 level, the market's going to run into some difficulties. The economic reports that came out, we had the IHS Market Services PMI. It came in at 54.9, greater than the 53.6 they had expected. This was the big one. ISM non-manufacturing came in at 50.3, less than the 52.3 that they had expected, and even down from the last time when we had this report at 51.9. Factory orders were up 0.4% month over month. They expected it to be double that, at up 0.8%. Last time it was up 0.6%. Let's go through some IsabelNet.com blog charts. The first chart just shows once stocks gain 20% off the lows, which we've done now, good things tend to happen. Might be a little hard to see, but this looks at the 1 month, 3 month, 6 month, and 12 month return going forward from here. This chart just shows record-shattering inflows into tech funds. Be a little careful with this because folks are chasing what's already happened, and sometimes that can signal some kind of a top. Then the sentiment indicator. I usually don't show this, but for the first time in a long time, we're actually going above this zero line, suggesting that people are getting a little more optimistic about the stock market. But we're not getting to an extreme reading right now. Then we look at the mega cap tech. Here you have the Magnificent Seven. This is Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia. How they're up 53% going back to the end of 2022. S&P 500 traders are net long in their futures contracts. This is suggesting things are a little bit more positive. Then the ISM manufacturing, it's under 45. We didn't get that level right now. We're at 46.3. And then we compare it with the non-farm payrolls, which we received last Friday, where this has also been pretty strong lately. And then we have the exposure to equities. They're still below this dashed line, meaning that they're still a little bit more defensive. And then exposure to bonds, also more defensive. And then I usually don't show charts like this because these numbers, it's like, what do they mean? We don't have anything to relate them to. What I want to do here is relate them to each other, where if we're looking positive, the earnings overall for the S&P will be at $251. The base case is at $241. The bear case would be if earnings drop down to $230. And then this gives the corresponding PE ratio, the price target, which we've already reached the 4,200 level, and then what is the upside or downside if these things tend to happen. This tends to be a little bit more negative overall because we're already above 4,200, and the base case and bearish case would suggest earnings have to come down. Tom McClellan had an interesting chart over the weekend that he posted on Twitter. Over here on the right, this is his tweet. It says, "The problem is that only occasionally are such big one-day moves signs of initiation." That's what we had on Friday, was considered to be an up day. Most of the time, they are termination events, and those are the blue lines that he's marked out here. He went through and said, when we had a big move, it marked either a top or a bottom in the market. There's one exception, which is the green line, where we kept going after that. Just something to be aware of. FedWatch, since we're coming up to the meeting on June 14th, we're still keeping an eye on this. There's a 77.1% chance that they're going to leave rates the same. And here's the change over the last few days, where it hasn't changed all that much from Friday to Monday. Looking at our charts, intraday, where we had a flat open, we actually were positive for a while, came down to the unchanged level, and then we started to chop a little bit higher. We got almost up to 4,300. We were at 4299.28. Then we started to come down, went negative, but found some support at the daily pivot, closed a little bit above that. Here's the intraday chart. We were pretty much flat in the initial overnight session as well as the pre-market session. This shows the action of the market during the day, and we're trailing off just a little bit in the initial overnight session. Growth and value were pretty much the same right now. And then we closed a little bit better with growth being down 0.1%, where value was down 0.22%. Same thing with the mid caps. They performed less bad on Monday, but the small caps just got hammered again on Monday, and they were down with the growth even more than value. Here's the intraday chart of growth versus value. It's a 10-minute intraday chart where we looked more positive after we opened up, but then later in the day when some selling came in, that took the growth to value ratio down. Looking at sentiment, we're still very complacent as far as our Ulcer Index. The VIX ticked up just slightly with the slight down day, both on the line chart as well as the bar chart. The VIX of the VIX, since we're chopping around a little bit, it's picking up a little bit of an increase in volatility. This is a chart that we were watching where we're seeing if it was going to go all the way up to this dashed line. It has now turned and gone back down. If this still continues to fall, I won't be including this chart anymore until the next time it shows something interesting. The equity put call ratio still going down overall. We're not really working off of a recent signal. We have previous signals that never really led to anything, but when this is going down, that means that stocks are going up. Here's an interesting thing too. This is a long-term moving average on the equity put call ratio, and I usually just go over this in the deep dive video because it's not telling us all that much. But now it is. In the beginning of 2022, we saw a real shift where the equity put call ratio had a long-term trend going up. We had a few little blips along the way that we thought maybe things were changing. We're also seeing it right now starting to roll over. Could this shift the longer-term trend back to a more positive stance? Then looking at the MOVE index, we declined a little bit with bonds. Of course, the VIX still remains very low. Then we have the spread between the two, which is the green line, and the S&P down here. Their correlated relationship is still very strong. The SKU index, which had been getting rather extreme, has now dropped back down. Maybe the big event that the market was anticipating was last Friday. Then looking at this fear gauge, we ticked up a little bit overall. And on the other fear gauge, we actually were pretty much flat on the day. We're still maintaining more of a risk-on posture, so folks are favoring stocks over bonds. Our advanced decline line studies, we're still hanging in there okay based on price, even though we were down a little bit. And this is a little more positive. We're above the moving average based on volume. The new highs, new lows. This is a concern, though. We saw a little bit of an expansion when the market was up, but our 5 period is declining and our 10 period is also declining. The advanced decline ratio, this is still somewhat positive. The blue line is still above 0 even though it declined. The red line is also just barely above 0. But our accumulation distribution, even though it declined, is still above an advancing moving average. We're still seeing a longer term negative divergence with the cumulative NYSE advanced decline line as well as the regular advanced decline line. We came right up to this trend line and we've been going back down. When we look at common stock, also a longer term negative divergence between price and volume. And the advanced decline line on this chart, we were able to get back above this trend line, so that's somewhat positive. On a broader measure, we're looking at the NYSE where it came up to its moving average, turned down. The S&P is right on top of its moving average. The mid caps turned down as well as the small caps. Looking at our trend, this is interesting. We're finally seeing the ADX going above 20. We haven't been able to say this since about last February. We've been below this blue line all of that time. The green line's on top, but it is declining, but it's pretty far away from the red line, so we default to the positive. Shorter term, we're also showing a trend with the green line on top, even though it's slightly declined. Volume did tick off in Monday's sessions, so it was back under being average. Our short-term analysis, we're still looking okay on the daily chart. We might have some support at these pivot levels here. And then on the bottom, you can see where volume really dropped off. The Stochk RSI, even though it turned down, is still extreme. The same thing with the Williams percent R. The CCI 14 is still extreme, and the CCI 20 continues to be extreme. The short-term stochastic, even though it's turning down, is still extreme. The intermediate term is also extreme, and we're seeing some improvement with the long term, and now it's starting to get extreme. The force index, even though it declined, is still positive. Some intermediate term charts, the balance of power, it declined, but it's still above the dashed line. The go, no-go system remains positive with the darker blue bars. TTM squeeze also continues to show strength. We're coming back down into the top part of this second standard deviation. After we had gone into the third one, we might have gone up pretty far, pretty fast in Friday's session, according to this chart. And we're still outside the upper Bollinger Band, which we measure by using the % B indicator. It's come down a little bit, but we're still extreme positive. The PPO studies still are positive even though the short-term declined slightly. The Erin indicator showing some improvement. Our oscillators going up. The green lines on top showing buyers are in control where the sellers are dropping off. The S&P 500 McClellan oscillator is still above zero even though it did decline. The NYSE McClellan oscillator is also still above zero even though it declined. The summation index, we're turning back up based on price, and we've crossed back above zero based on volume. The NYSE summation index, still seeing a longer-term negative divergence, but we showed some improvement based on price and volume. The Swenlin trading oscillator, looking more positive, above based on price and volume. The Elder Impulse system for the S&P still remains positive. The PMO study, the PMO's turning up. We're not quite crossing positive yet based on price, and we are looking more positive based on volume. The PMO study, with the PMOs that are above zero, turned down slightly, but we're looking a lot more improved. The buy signals are advancing, and we're turning back up with the PMOs that are above zero. The slope indicator continues to point up. The MACD is also going up. Looking at all of our oscillators, they pretty much have gone back to positive. We're seeing the tricks in the KST trying to turn back up positive. We're still above all the plotted moving averages in our moving average tree. The Sean trend meter is still extreme positive. The parabolic SAR system is still positive with the dots underneath. The BPI, this is also kind of positive. We crossed back above 50. And the NYSE bullish percent index, though, even though it showed some improvement, is still below 50. The Chaikin money flow continues to be positive, even though it declined slightly. The vortex is still positive. The money flow index is positive. The Chaikin oscillator ticked down a little bit, but is still positive. The ultimate oscillator also turned down slightly, but is positive. On balance volume, we declined, but we're still above this moving average. The RSI turned down just a little bit, but we're above 50, both with the 14 period. We almost got to an extreme reading on the 9 period, but we're turning back down slightly. This is the new chart that I haven't shown in the daily videos for a while. We're starting to look a little extreme with the 20 period boom indicator. This measures how far away is price from the moving average. Moving averages tend to act like magnets, or price acts like a rubber band. If it gets too far away, it has a tendency to come back. We're showing that on a 20 period moving average, we got pretty far away. We're looking better with the 50 and also the 200. But longer term, we're still seeing a negative divergence. When we look at the 200-day and 50-day moving averages, we're not really seeing a lot of participation on a broad scale inside the S&P. The Copic curve, however, remains on a buy signal, as does the Pring bottom fisher. Looking at our Fibonacci lines, we're still above this 4170 level. If we start to fall, we'll be looking for that as support. We're still above this 100% retracement level on our short-term fib chart. If we fall, we're looking at 4123. Longer term, we might have some overhead resistance above 4300 at 4313. Longer term, we also, if we start to fall, may have some support at 4214. We're still above this upper trend line when we look at our downward sloping trend channel. There were a lot of folks who were just sure we were going to bump into this, turn, and really start heading lower. That hasn't happened, at least yet. Our different charts, the Heiken Ashi is positive, the Kegi chart is positive, the Renko is positive, the 3-line break is positive. Looking at some different indexes, we turned down just slightly with the equal weight index, and they still continue to underperform the S&P. We're still seeing a longer-term negative divergence with traditional Dow theory between the Dow and the transports. Shorter term, even though there's an improvement here, we're still seeing a negative divergence with the utilities. Our new look at Dow theory, we're still above this blue line where we broke out with the S&P as well as with the NASDAQ. The transports are still underperforming the Dow. That could be longer-term negative. We saw a little bit of a tick down in this ratio, but the big stocks are still continuing to outperform the smaller stocks. The Dow, after getting back above its 50 and 200-day moving average, did see a bit of a retreat. The diamonds still remain positive. When looking at the Elder's Impulse system, the NASDAQ fell back just a little bit. We do have some overhead resistance at R1, but it's still looking more healthy. Here's the NASDAQ where we're above this 50% retracement level. If we fall, will that provide support? But when you look internally in the NASDAQ, we're still seeing the new highs, new lows based on a cumulative basis. They are declining. When we just take a raw value between the two, we have gone slightly positive. The NASDAQ 100 also looking pretty strong, may have some resistance at this R1 level. The Elder Impulse system for the Qs has switched back to neutral, and we're still above the 61.8% retracement level. Another thing that a lot of people were referring to was this level, and we might bump into this and go back down. So far, we've been above it. Even though we're seeing a little bit of improvement with the NASDAQ 100 BPI, there's still a negative divergence. Where the NASDAQ 100 was going up, we didn't see a corresponding rise with the BPI. Longer term, though, we are looking positive. Small caps still are negative. They really shot up to the 200-day moving average on Friday. Now they have dropped and even put in a low at the 50-day moving average. But the Elder Impulse system for the small caps remains positive. The small caps are still underperforming the S&P 500. Here's the Russell, where the RSI is above 50, but it did decline. The MACD is still looking positive. But when we compare small cap growth to small cap value, it's actually still hanging in there, even though the index has been going down overall. Then mid caps, we're still slightly above the 50 and 200-day moving averages, even though it was down over 1%. The Elder Impulse system for the mid caps remains positive. And also, when we look at mid cap growth versus value, it ticked up slightly. And going back all the way to the beginning of the year, growth has really been outperforming value, even though the index itself has been underperforming. Here's a newer ETF that I'm starting to include. It has to do with robotics and AI. It's really been performing quite well overall. This seems to be the new buzz in the markets these days. Keeping an eye on the financial sector, we were down a little over 0.5% and continue to be in a downtrend. The financials are underperforming the S&P, and the regional banking ETF showing a little bit of improvement compared to the financial sector. Keeping an eye on bonds, pretty much unchanged on the 10-year, both based on the yield as well as based on price. And then we're looking at this longer-term correlation that tends to be fairly positive. It's still suggesting that they're going in opposite directions. Shorter term, we are showing some improvement, but the spread between the two is really wide. We're also keeping an eye on this. We're breaking out above the 3-month yield. The last time we were at this level was right before we had the great financial crisis. Is this a warning sign? Looking at our interest rate studies and analysis, this is the basis of the previous supplemental video where we compare the S&P to the 3 to 7 year Treasury bond. We're still going up overall, suggesting that the economy may go into a soft landing. This is an inverse of that same chart showing how bonds are underperforming. Then we're looking at the 1 to 3 month T-bill, which is cash, and comparing it to longer term bonds. We're going back up here. We crossed down below, and this was really looking to shift, but now we're starting to go back up again. That's a little bit of a concern. When we compare the broad market, looking at the S&P 1500 and comparing it to shorter term bonds, the broad market is really outperforming, and we're above all of the lines in the rainbow. Then we look at the broad market with little longer term bonds, and the broad market is still outperforming. We look at riskier bonds that give a higher yield and compare it with more conservative bonds. We're still inside the rainbow, but this ratio is showing some improvement. Then we look at the tech sector compared to bonds, and it's really been outperforming. Our long-term analysis, we're still below this red line on the special K. We're trying to turn back up. Can we cross over positive? Then long-term, the MACD is still looking good, suggesting that this breakout above the trend line is still legitimate. An update of our possible positive scenarios, we're still positive based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. Looking at our other ratio charts, the Qs turned down just a little bit but remain strong compared to the S&P. Discretionary showed a little bit of improvement, and large cap growth, even though it turned down compared to large cap value, is still strong overall. Then we look at our growth to value ratios. The large caps are doing good, turning down a little with the mid caps, but they're still strong. We're still showing some weakness with the small caps. But when we look at S&P growth versus value, we ticked back up slightly. We had been really going up since February. Now we've been more or less chopping sideways with this ratio. This is another positive. The S&P continues to outperform utilities, When this is going up, that gives really good support to the S&P. When this is going down, that can really put some pressure on the S&P. We're still negative when we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of their highs minus their lows. Longer term, we're also continuing to decline with our 50-period moving average of the new highs minus the new lows. But on this chart, we have turned slightly positive. The indicator has gone back above zero. 2-year Treasury yield. We're still wondering if this spike right here will give some more support to stocks. It's already helped a little bit, but now we've been seeing the yield going back up. This is also positive, where the staples are really underperforming the S&P. Other times when we spiked and went down, that gave really good support. The one caveat with this is when this spiked, we had already run up with the S&P quite a bit. We're going to have to gather our breath, so to speak, before we get set to move higher. So what's our outlook for Tuesday? We still have to deal with earnings season. The technicals, they're still positive overall. The negatives and negative divergences that we're seeing still continue to show some improvement. We don't have any economic reports coming out on Tuesday. We're switching back now to inflation and interest rates. The debt ceiling issue is pretty much done now. We're also wondering if any new banking information is going to come flying in at some point. Here's a weekly chart of the economic calendar. Here in blue are the reports that came out on Monday, none on Tuesday. Really kind of a light week overall as far as the economic reports. But in the following week, that's going to be the real barn burner because that's when the Fed meets. Looking at our Stock Traders Almanac statistics for June 6th, tend to be quite positive with the Dow, where we're neutral to positive with the S&P and the NASDAQ. We're on the 4th trading day of the month. This is what Jeffrey Hirsch has been saying in some of his Twitter posts, and I hope you're able to read this, where it basically just says we see a good start to June, then some weakness. Throughout most of the month, we see a good solid gain. We get into the latter part of the month where we see some weakness, and then we end up finishing up strong. We don't know if that's what's going to happen this time, but historically that is what has happened. And then Dan Bird put this chart out where he's more focused on the NASDAQ, where their best 8 months tend to go into mid-July. When you look at the S&P, their best 6 months tend to end in May. Then we're also keeping an eye on this. Going back to 2011, we now have a debt ceiling deal that has been passed. Is there going to be some weakness like there was back in 2011, followed by a bounce? And then when we get to the latter part of July and into August, are we going to see some more weakness? Chris Schiffako also posted a chart saying pretty much the same thing, but just looking slightly different. From the top in 2011 to the bottom, we fell almost 20%. So our scenarios, can't really go with the down one right now, but we can go with the up one because the ADX has crossed above 20 and it's above its moving average. You can't really go with the sideways one now because we are starting to show a trend, both on our shorter term ADX and our longer term ADX, but the green line is declining, so you want to be really careful if you assume any kind of long positions. Warning signs. The new highs and new lows in the S&P are not expanding. Also, the BPIs are diverging, but the SPX BPI has crossed back above 50. There's a lot of negative divergences and signs of weakness that are still under the surface. The VIX is still showing a lot of complacency. The new highs and new lows on the NASDAQ are showing weakness. The 3-month yield is above what we saw going back right to before the great financial crisis. Small caps and mid caps have generated recent death crosses. And earnings season continues, but someday it will actually be over. Positive signs. We do have seasonality and setups. Those apply to the whole year. The Koppik curve and the Pring bottom fissure are both generating buy signals. The S&P is still above that downtrend channel upper line. We're still in a risk-on posture. Lower price levels may provide support. That could be a Fibonacci level. It could be a moving average. It could be a previous price. It's always hard to pick those out ahead of time. The S&P is outperforming utilities. That could give some good support. The NASDAQ and NASDAQ 100 continue to break out even though they were down on Monday. And staples to S&P 500 ratio is declining, which could give some really good support to the S&P. Small and mid-cap growth is still showing overall strength. Our conclusion, the S&P, it's positive, but it still has a lot of negatives and divergences, but we are seeing some improvement. Short term, we're positive, but continue to be overbought. Intermediate term, we're also positive and slightly overbought. Longer term, we still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.